We now are in the next major commodity super cycle. Everything related to commodities and hard assets is up. And it goes back to the whole inflation argument. It's not just gold. You want to know that there's real inflation, just look at commodities. Everything from iron ore to lumber to titanium to, you name it. Everything is moving. And part of it is driven by the fact that as we come out of this period of restriction and stay at home, there's going to be renewed economic activity. But part of it is supply chains have been dried up. Supply chains have been destroyed and decimated over the last year and a half, and they're going to continue to be underinvested and underdeveloped because we're still not back to normal. So there's a real issue with supply chains out there right now, which is really actually also a national security argument, because these are the critical minerals of the 21st century that are going to drive these major trends around decarbonization and electrification. And you cannot talk honestly and genuinely about those mega trends without having the available supply chains and the raw materials needed to drive it. And if you're going to be at the mercy of countries that you don't share the same values with, then it's going to be very hard to set these goals and promises of net zero carbon emissions by 2050. You got to be in the control of your own destiny with raw materials and hard assets today in the 21st century more than ever before to build the next century for humanity and for the next generation of people that are going to inhabit this world.
This is Donnegan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver dealer with Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized, private service from one of the oldest and best respected companies in the business. 30 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded, insured delivery or vault storage or IRAs, excellent prices, privacy and confidentiality, pay by check, money order, ACH or wire, satisfaction guaranteed. Call me directly at 419-819-9209 or my associate at 310-562-6400 or email us at kaiser@milesfranklin.com. Welcome back to Liberty and Finance. We have a first-time guest today. This is Amir Adnani. He's the founder and chairman of GoldMining Inc. He joins us this Thursday, April 29th, 2021. Amir, thank you for coming on to our channel for the first time.
Yes, my pleasure. Thanks for having me.
Yeah, you're very welcome. And thank you for making the time, because we've been recommended to you and to your company by Rick Rule, formerly of Sprott Asset Management, now of Rule Media. And he's been after me saying, when are you going to get Amir on? Because he says you often have lots of activities, opportunity, and value propositions that our audience might benefit from. So that's one of the reasons we have you here. The other is because of your experience as an entrepreneur in the precious metal space. Precious metals are of high interest to our audience because they're interested in things that are real rather than fiat currency and a lot of the debt that puts them at risk financially, individually, or all of us together collectively. So if you could start us off there and talk to us about the gold market and how it's been performing and what you think are the major factors that are driving gold, and why we maybe saw a big run-up in Q3 last year, and why gold has been not yet retesting those highs again since then. So could we start there with what's driving gold, and what do you see next?
The most important driver of the gold price, in my opinion, remains its relationship with real interest rates, so nominal rates adjusted for inflation. And when we saw the real rate environment go deeper into negative territory last year, we saw a corresponding move in spot gold approaching the all-time high of $2,100 an ounce. When we look at the fact that we've seen a bit of a retreat there with the real rate so far this year, you see that commensurate sort of pullback in the gold price. I think as real rates go, so will the gold price. Of course, there's also the relationship with inflation. I think the relationship with inflation is arguably broke, mainly because it seems to me now more than ever the barometer and the measure and the basket of goods that the Fed is using to determine inflation is simply broken. In fact, it's now becoming laughable. And soon I think it's just going to become infuriating. When I talked to a good friend this morning who's talking about how he's trying to tackle updating or upgrading a deck that he wanted to build, getting ready for summer months coming up. And the price of lumber is 3 to 4 times higher than what it was. And that's assuming you can find it. And then you got the Fed coming out and saying just 24 hours ago that they're having a hard time meeting or hitting their 2% inflation target. This is not just becoming stupid. And it is a broken system. It is a broken barometer or measurement that they have as a basket that they're tracking. Not only do we have asset bubbles, kind of valuations for so many different asset classes or sectors are through the roof and at levels that you can't make sense of anymore. But you see runaway inflation in everyday life. Again, maybe lumber isn't something you talk about every day, but it certainly is something that is in everyday use and something practical in front of us that we can see and feel. I think we have a very similar issue in gold. Gold from a physical side is constrained, and it's constrained because we have a serious crisis of reserves and resources that are looming for the sector. The gold sector spent the last decade deleveraging balance sheets led by major gold producers, focusing on just tightening cash flows and making sure they can meet their dividends. And that means the first thing that was out the door and wiped clean was any spending on exploration and development. That's the lifeline of the industry. And when you look at the total gold reserves today compared to a decade ago, they're 40% lower. And today it costs more to explore and look for gold. It costs more to bring mines online. It's more complicated because of all the restrictions and issues around COVID. Last year alone, you had hundreds of precious metal mines that had to shut down due to COVID-19 related disruptions. And exploration is a long-term exercise. It could take a decade to go from exploration to permitting. Permitting takes longer today because of a variety of necessary stakeholder engagement work that a company needs to do to get a social license, in addition to getting a statutory licenses. And so from a standpoint of the supply demand or the physical side of gold, I think there is a serious issue of global reserves and resources being in decline, having been in decline for over a decade. That coupled with the fact that gold, to me, today seems to be the most undervalued asset class because this seems to be the only asset that is truly not in a bubble, whereas everything else is in a bubble, truly. And that, to me, is actually why it's so compelling to be thinking about gold and looking at gold today as an investment.
Yeah, a lot of the things you just went through just followed along what a lot of other guests that we've had on have warned us about. I was thinking about John Williams from shadowstats.com talking about the concerns with the headline numbers for the consumer price index that do not reflect the reality of people's lives and the real economy, as opposed to the Chapwood index that's indicating much higher levels of inflation. And both he and E.B. Tucker, who we had on, talking about how gold is normally serves as a signal to tell you that, and it usually will tell you ahead of time before the authorities will admit it, that there is inflation, because it will tell you as a truth serum what's really going on. But that signal seems to be broken. We also have multiple people talk to us about the Ibbotson study about asset class correlations. As you were saying, people who feel that we're in a bubble of everything, it's like, well, not quite everything. Not everything. Yes, we have stocks, we have bonds, we have real estate, all these things in a bubble. But when people want to protect themselves, and that's, again, the root of our channel is about people being aware and prepared of risks to their finances and other aspects of life, but at least in their financial lives, how do you protect yourself from a downturn or a reset or a bursting of a bubble, the stock market crash or bond market crash, if, in fact, there's only it sounds like precious metals, gold and silver, that kind of thing, are the last asset class remaining, according to the Ibbotson study, that can be used as a hedge. And then the last thing you mentioned was Keith Neumeyer, also with Rick Rule here, talked about this massive metals shortage coming and how the exploration and development and all that has lagged a decade behind. And now we're going to have off to the races as far as demand, but there's no way that realistically production is going to be able to keep up. Can you circle back with us on that topic in the middle there of gold as a truth serum, or gold as an early indicator of real inflation? You'd think now, if we are experiencing real inflation that's not being acknowledged by the officials, that we would still be seeing the truth of that reflected in gold. Are we going to? Do you think that will break through and that will reassert itself, or is it clamped down? Is it under control so it can't tell us the truth about inflation?
It's an abnormal situation. I think what you mentioned about the truth serum perhaps would be correct under normal circumstances. I think we are far from normal. You look at what normal means in terms of human movement, free movement, freedom to be able to run a business as simple as a restaurant. In Canada right now, you can't go out. There's full lockdown here. You can't travel. You can't leave the country. There's bans. There are all sorts of restrictions and issues in the U.S. And what that does is that it creates this abnormal environment where most people are sitting at home and taking outsized risk with capital and really plowing into anything that has so-called momentum, looking to just make money, looking at basically trade and gamble and do things that I don't think you would be doing in a normal world. And certainly the world we're in right now and the way we're functioning, it's not sustainable, first of all, because it's just not financially sustainable. It has all sorts of impacts longer term on mental health and other degrees of sanity. Mm-hmm. But in a regular normal world, what you would see in terms of risk management, wealth preservation, would have a different impact in terms of how it would manifest itself in why someone would look for, let's say, an inflation hedge, a true inflation hedge, which is basically gold. Whereas right now, it's all, in my opinion, about momentum, and it's all about trying to. It's really the whole world has become one big casino, and that really is, I think, most perfectly amplified and expressed in what's happening with cryptocurrencies. I mean, it's just how it's borderline reached the level of comedy, the comedy around what we're seeing kind of take place here with not Bitcoin or Ethereum, but you look at what's happening with Dogecoin, or you look at what's happening with a variety of these things. This really tells you that people are not chasing what would be sound economic way of looking at wealth preservation and wealth growth, but rather just rolling the dice on everything possible that seems to have a shot at going up. These are not really normal activities or normal times. And maybe the truth syndrome notion of gold that you're talking about is going to be more realizable in a more normal environment. And we are going to normalize at some point, because this way of doing things is also just not sustainable.
In the event of a market downturn, whether it's gradual or an actual crash, and whether there's a bond market crash, we certainly saw some when the U.S. Fed had to start doing these nightly repo actions starting in September of 19 to the tune of hundreds of billions of dollars per night because there was this drying up of liquidity between U.S. banks and others that didn't trust each other even overnight. Do you believe that there are structural risks in the debt market or in the overvalued equities market that could result in a crash at any point that people won't necessarily have advance warning of?
It really makes you wonder what could happen if the Fed laid off the monthly, what's the latest, $120 billion a month bond buying program, right? Mm-hmm. Because that is without that, then you'll really find out, how everyone is swimming, right? And who's swimming without any trunks on. That That is just an incredible amount of liquidity in the system. And without that, and at some point, again, that has to be curtailed, some real risk and some real systemic risk and structural issues are going to expose themselves. There's no doubt about it.
In the light of that, companies like GoldMining Inc. or others are having to continue operation in an environment where there may not be natural price discovery for the market. How does that affect your ability to make progress strategically and tactically as a company?
We had sort of a longer term way of looking at this, and the longer term way of looking at it was between 2012 until early last year, where we had a gold price that on average was sub $1,300 an ounce. We were looking at and were able to successfully acquire resource stage gold projects with gold in the ground, basically valued at 10 cents on the dollar equivalent. And that was an exercise that we embarked on, and we kept with and just continued buying assets where we thought they were valued at less than their discovery cost. Mm-hmm. And discovery cost is not only just the hard dollars associated with going and looking for an ounce of gold in the ground, but again, the time it takes and the risk involved in exploration and all the issues and ups and downs of mineral exploration in various countries, mining codes, languages, cultures. It's a time-consuming exercise. And so we felt that when you can acquire projects that have previously been explored and developed for bottom of the cycle type valuations, that's the way to go. And you had to align yourself with like-minded individuals as shareholders that would back that. So you mentioned Rick Rule at the outset. This is a strategy that Rick Rule as an investor has probably perfected when it comes to understanding the cycles and taking advantage of cycles in commodities when it comes to investing, and investing truly like a contrarian. Mm-hmm. You know, Rick was a very early backer of entrepreneurs, people like Bob Quartermain or Ross Speedy, that did something similar to what I'm describing in the 90s when it came to silver, acquiring silver resources in the ground that were, in a way, at the time, at low silver prices, were uneconomic. So they're akin to a out-of-money call option. Repeating that same strategy with copper in early 2000, with Lumina Copper acquiring copper resources in the ground when copper was trading at well under $1 a pound. And as copper prices appreciated in the last super cycle for commodities, we're able to turn that business and successfully realize value. And what we've done with gold mining is really trying to replicate, and the strategy, going back to your question, being one of saying, commodity prices, when they are in an environment of too much supply or lack of interest in that commodity, and they fall into cyclical low environments, they become like a out-of-money call option, and they become you see extremes in valuation. We acquired projects and companies during 2013, 2014, 2015, when gold was approaching $1,000 an ounce, that used to have market valuations of hundreds of millions of dollars, and we were buying them for $5 to $10 million in 2015 timeframe when gold was closer to $1,000 an ounce. But what we were doing, in my opinion, wasn't novel. It wasn't rocket science. It was repeating what other businesses or entrepreneurs and commodities have done in previous cycles. You have to be contrarian, and you need to be patient. It can take a long time when you're in a bear market. Last year, while we witnessed many challenges in running physical businesses because of all the COVID-related issues, we did notice that there was an inflection point for the commodity prices, and that we were arguably entering, and gold did lead the way last year and took us into where we now are in the next major commodity super cycle. Everything related to commodities on hard assets is up. And it goes back to the whole inflation argument. It's not just gold. You want to know that there's real inflation, just look at commodities. Everything from iron ore to lumber to titanium to, you name it. Everything is moving. And part of it is driven by the fact that as we come out of this period of restriction and stay at home, there's going to be renewed economic activity. But part of it is supply chains have been dried up. Supply chains have been destroyed and decimated over the last year and a half, and they're going to continue to be underinvested and underdeveloped because we're still not back to normal. So there's a real issue with supply chains out there right now, which is really actually also a national security argument. But staying with the theme of commodities, we looked at it last year and said, we're not going to see $1.50 copper. We're not going to see $1,300 gold. And so what that means is, as a company now, we had a certain vision and strategy for the last decade, and now we're going to, which was to be, I say, for the last decade, we were like Vikings. We were just out there and we were just grabbing stuff. And now for the next decade, we're going to be more like farmers. We're going to sit down. We're going to look at this massive portfolio of assets we've been acquiring. And now it's about daylighting value. It's about advancing these projects, de-risking them, selling some of them, finding partners for some of them, advancing some of them towards production with our own capital. In one event, we created a royalty company called Gold Royalty that we created royalties on all of our existing projects and launched a new business with that. So this new phase of what we're looking at with commodity prices doing what they're doing, both because of inflationary issues and real physical constraint issues, I think this is a phase to be harvesting. This is a phase to be realizing value for hard assets if you own them, create more value for it. I don't know how long this takes. As an entrepreneur, I always take a long-term view. And so longer term, I think we're in that phase now. Month by month, I don't know how it plays out, but I think last year was a really key pivot point, and we're part of that pivot now moving forward. What I'm focused on is really development and unlocking and realizing value for the last decade of work where we were mainly focused on acquisitions.
I think that what you just described may key into this question that a viewer submitted. Lofty Ken says, why are my GoldMining Inc. shares still more than 50% down? Have you made any change to the share structure of the company? Currently, it's the worst performer in my mining portfolio. So you talked about Rick Rule as a legendary contrarian investor who looks for value. And you talked now about the turning of the page for GoldMining Inc. in terms of going from an acquisition mode into a development mode. Can shareholders like Lofty Ken look forward to appreciation of profits that will flow from those activities that you're describing that you're going to be starting?
You just have to look at last year, and last year where we did see a better environment for gold, and it's all relative, right? So last year, gold prices were much, much stronger, went as high as $2,100 an ounce, but we were also coming from a period where gold prices were quite weak. And when you look at last year's share price performance for gold mining, it was one of the best performing gold stocks in the world. It completely outperformed, let's say, not just the spot gold price. You would expect it to outperform gold. But for example, the GDXJ, the junior gold ETF that Van Eck operates. And so when you look at last year where we had a stronger gold price environment, stronger sentiment for investors towards gold, gold mining completely outperformed. This year, year to date, we've definitely seen a more subdued sentiment towards gold. Gold equities in general this year are not performing as well as they did last year. Again, we can go and look at the basket from gold, the gold junior ETF, GDXJ, and all the way down. Gold mining is not alone in having less stellar performance, or in fact, underperforming this year. That is a nature of sentiment. Sentiment, again, towards gold this year has been softer, and that can change. It can change on a dime. Just like last year, we went from the first half of the year not being as strong for gold. There's seasonality in gold. Last year, we saw the fourth quarter of the year from sort of August onwards be fantastic for gold equities and gold as a commodity. So this, again, goes back to seasonality around commodities. There's definitely strong seasonality towards gold. It goes back to cyclicality. You're not going to just be the top performer year in and year out. There's going to be pullbacks, consolidations, sector rotation. What we know about gold mining today is that you have a company that is, in fact, today, right now, this moment, significantly stronger, in my opinion, than it was a year ago when it was almost 50% to 70% higher in share price. And the simple reason for that is We still own the 31 million ounces of gold equivalent resources that we did last year. But today, we also have 20 million shares in Gold Royalty, representing 48% of that company, listed on the New York Stock Exchange with 90 million in cash in the bank. We own 48% of that company, with mark-to-market value of our shares reflecting close to $100 million of balance sheet value. So you have the same company with the same amount of ounces, except an additional $100 million of equity value on its balance sheet, but instead of trading at $3 a share, trading at $2 a share. I think that's a really fantastic argument and setup. I think if you take the balance sheet assets out and you just look at the value of the resource in the ground, the in-situ valuation is $5 for resource in the ground. You just don't get cheaper than that for 31 million ounces of gold and copper. And a year ago, copper wasn't over $4 a pound. It was strong. It was $2.50 to $3 a pound. Today, we're looking at copper prices at decade highs and perhaps heading towards all-time highs. And gold mining controls 2 billion pounds of copper resources, which is how on gold equivalent basis, we go from 25 million ounces to 31 million ounces of gold. So I think this is a very strong company with a very strong portfolio of assets. It's undervalued today relative to where it was a year ago. But that can change the moment I think we start to see more news flow out of the company and improve sentiment for the commodities. Copper is already very strong, but because we're primarily a gold company, gold sentiment is probably what's going to lead the day for us. Look, I'm the largest individual shareholder of the company. Of course, I would want nothing more than to see stronger share price performance. But I think the company is going to get there one way or other sooner than later.
That's a related question here, and we've heard others echo that. We've had Claudia Thornquist from Kodiak Copper and others on talking about how, and Keith Neumeyer talking about how the green economy is likely to impact the demand for copper and related metals. Bubbles Bernanke says, my question for Mr. Adnani is, Western societies, right or wrong, are on a marketing crusade for green energy. Does that suggest, so you've got one foot in uranium as well, which may be not in the green spotlight, but on the other hand, copper likely to be highly in demand. So do you think the uranium mining industry should be alarmed? And as a sidelight, will this help, will the green new economy, if it's pushed through, help GoldMining Inc. because of the copper demand?
The goals that are being set. So let's just look at the U.S. In the U.S., when you look at the Biden administration's green energy mandate, clean energy mandate, the target to be net zero emissions by 2050. Whatever your thoughts are on these goals are being set. And in order to meet them, we will need a host of commodities and a lot more of such commodities that play a role in generating emission-free electricity, all the way to the batteries and storage of electricity to meet these goals. And so the areas that should be noted here, uranium in particular, is the fuel that allows the generation of the largest form of power generation that is emission-free is nuclear power. So certainly there's a great position and place here for uranium to play a role as part of this green energy plan. Copper is the next one that is so critical to when it comes to the basically the battery metals that we talk about. Then you get lithium and you get nickel and cobalt and a host of other things. There's no doubt about the fact that today when you listen to the CEOs of the largest gold companies, you look at Mark Bristow at Barrick, they prioritize the focus on developing gold deposits that come with copper. Gold and copper deposits are definitely a form of deposition that are not only available, but also gold, copper, porphyry deposits typically tend to be large, very large, and happen to provide that type of conventional bulk tonnage mining that allows that producers and the larger producers are also comfortable with. This is a very interesting position to be in for gold mining because we prioritized as early or as far back as 2015 the acquisition of gold copper projects. The first gold copper property that we acquired was our Whistler project in Alaska in 2015. This is prior to all this stuff. I mean, back then, President Biden was Vice President Biden, and it was another world. We have been acquiring gold copper projects back in 2017 in Colombia. Our La Mina project is a very strong gold copper resource with a very strong grade. And so this is when you go back to the vision of our company. We had this vision and this priority set many years ago to acquire projects anticipating a certain outcome in demand and development in the industry. And now it's starting to play out. We also, I think, need to recognize the importance of these deposits and resources in stable jurisdictions where you can develop them. It shouldn't be lost on us that the amount of capital out there that has been benchmarked to ESG protocols, environment, social, and governance parameters, ESG investing and its rise, it's undeniable. The total amount of assets under management today compared to just 5 years ago or 10 years ago has seen multiple expansion. And that's why you see on a daily basis, you see pressure on fossil fuel companies. You see pressure on Exxon, for example, from these ESG mandated funds, mandating them to do something. And you don't need to listen. But if you lose that type of investable capital as a public company, it affects your cost of capital for future project development. It can't be ignored. And so ultimately, if you can develop projects in stable mining jurisdictions where the rule of law and the ability to meet the requirements for ESG investors, coupled with having your own parameters in place for gaining stakeholder support and then meeting regulatory objectives. I mean, first of all, this goes back to my earlier comment about how it is a tough business to be in, the business of mine development and mining. But you bring it back to the realities of what kind of mines will ultimately benefit from lower cost of capital, hence ensuring greater return on investment, and then hence being able to clear the hurdles to move forward. Jurisdiction really matters. And supply chains really matter. Prior to COVID, maybe we cared, all of us, less about where supply chains of everything came from. I know from my work in the uranium business today that some of the biggest topics for policymakers in Washington, D.C. are supply chains. Supply chains of everything matter. You and I care where masks come from, where vaccines come from, where pharmaceuticals come from, where we care more about that today because a major pandemic made us realize that we have supply chain vulnerabilities. Mm-hmm. And so today, it is almost a national security imperative to make sure that there's enough copper available in the U.S., that there's enough uranium available in the U.S. or in your own backyard, because these are the critical minerals of the 21st century that are going to drive these major trends around decarbonization and electrification. And you cannot talk honestly and genuinely about those mega trends without having the available supply chains and the raw materials needed to drive it. And if you're going to be at the mercy of countries that you don't share the same values with, then it's going to be very hard to set these goals and promises of net zero carbon emissions by 2050. You got to be in the control of your own destiny with raw materials and hard assets today in the 21st century more than ever before to build the next century for humanity and for the next generation of people that are going to inhabit this world.
It's very interesting, I think, to our audience too, because we've talked about for 8 years on this channel about getting connected with where the things that you need to live come from. We've had strategic farmers on talking to us about getting to know your farmer, know your food. Where's your food supply? How are you securing your food supply as a family? And on and on and on. This is an example at a state level that you're describing, but it's also is very real to people, and that's also why they care about, frankly, gold. Another reason is because they want to know where their nest egg is, and where is it really? If it's stored off in some fiat brokerage account that you could lose access to, or capital controls could be installed, or if it's again a cashless society, you don't get access to what you really need. So on both the vital fronts of food, currency, and you also mentioned strategic materials. Our audience are very aware of the necessity of knowing where what you need is coming from. Very good point. If people want to find out more specifically about GoldMining Inc., where should they go?
GoldMining.com. That's our corporate website. You can follow me on Twitter at Amir Adnani. I talk about the two yellow metals, as I call them, gold and uranium. That's near and dear to my heart and my entrepreneurial activity.
And Amir, we just are grateful for you. It sounds like we've got more angles on this that we could explore in the future, both from a base metal standpoint with your copper involvement, as well as the monetary aspects and concerns that our viewers have, as well as uranium and energy for the next century. A lot to explore. Glad you're here with us for this first time on Liberty and Finance.
It was my pleasure. I look forward to coming back. We have so much more to cover. It's difficult to do it all in one session. So future episodes are needed.
Very good. Thank you.
Thank you.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver dealer with Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized, private service from one of the oldest and best respected companies in the business. 30 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded, insured delivery or vault storage or IRAs, excellent prices, privacy and confidentiality, pay by check, money order, ACH or wire, satisfaction guaranteed. Call me directly at 419-819-9209 or my associate at 310-562-6400 or email us at kaiser@milesfranklin.com.